Good morning, everybody, and welcome to this panel, where we will be looking at ways in which infrastructure projects in Africa could actually attract private institutional investors' capital. So we have a very distinguished panel here. What I propose is that I'm going to ask a question to. I'm not close to I should be closer to the mic. Yeah, I'm going to ask questions to the panelists, first round of questions, and in answering the questions, the panelists may actually also tell us what they do. And after the first round of questions, we go to the audience for additional questions to the panelists. So first, couple of words about myself. As Barbara mentioned, I'm the global head for IFC Infra Ventures. This is the project development business of the World Bank Group, which is housed within IFC. And we develop infrastructure projects across the world with two regions of focus, Sub-Saharan Africa and Asia. In Sub-Saharan Africa, we have a number of projects which are under development, including some projects that have already achieved financial close. And in fact, one of our projects is already delivering power to the population of Senegal because it achieved commercial operations. But we have a number of projects still under development. So let me start. The first question, I think I'm going to go to you, Akwesi. Please, can you tell us some of your views about this new phenomenon that we are seeing in Africa today, which is the import of gas in the form of LNG as a source of supply for energy, mostly in the power sector. So what are the critical issues that you see to de-risk such projects so that this project will be attractive to institutional investors and lenders? Can you share some of your views, please?
Thank you. My name is Kwesi Tia. I'm from Standard Bank, focusing mainly on oil and gas across the whole value chain in Southern Africa, and also looking at the interplay of oil and gas with energy, electricity in particular. I think just start with the context briefly. We know Africa as a major producer of hydrocarbons, and we export some of those, whether it's gas, oil, and things like that, and maybe some usage of that domestically, whether it's Algeria or maybe Algeria exporting to Morocco through pipelines, and some gas from Mozambique that comes to South Africa, particularly for use by Sasol and also in the Johannesburg area. But increasingly, we are seeing a change in context, first also by market conditions and also by changing global policy frameworks. And what we've seen, especially post-COP21, is that coal is increasingly under lots of pressure from a financing point of view. Some of you might know that JP Morgan announced that they won't be participating in financing any new coal projects. And also globally, it is a situation of a buyer's market when it comes to natural gas, liquefied natural gas. At the moment, with global gas prices at an unprecedented low level, expected to be there for quite some time because there's just lots more supply than demand globally and lots more projects potential that can come on stream. And also the third one is that there's some experience, particularly in Latin America, with some developing countries that have successfully been able to pull together such gas-to-power type projects. And therefore, you're seeing African countries that are looking at these type of projects. South Africa has got a program at the moment. If you combine everything that has been announced, potentially 4.5 gigawatts over the next 5 years that may be put on stream from gas. That's for a country that doesn't have any gas. Ghana has got 3 projects on 2 sites that they are investigating. Kenya has announced some intent. And also Morocco has got projects that will rise to more than 3 gigawatts over the next 5 to 10 years. And therefore, when you look at projects of that nature, which have not been done on the continent, on that scale, what are the critical issues? And I think generically, like in any project, you look at the development risk side, which includes issues around the country, the policy, the regulation, and then from the project level, we spend a lot of time looking at the nature of the sponsorship. And that sponsorship in this context means also the attraction of international experience, expertise, and capital, because some of this knowledge may not exist in those markets. And then the second one that we tend to also spend a lot of time looking at is the actual development of the project. Because now you've got a project with different value chains. You import gas, you have to regasify this gas, you have to transport it, you have to convert it into power, and then you have to have an off-taker at the end. How do you make sure that each one of those components have got the right type of sponsor and also the right credit quality, particularly at the off-take level? And this is where the issue of sovereign and the capacity of the country or the sponsor in the country who's doing the off-take becomes very, very critical. Because unless you've got that, the project doesn't become sustainable or the risk is not that easy. And the last one I want to cover, I mean, I can pick some things up during the questions as well, is the issue as how, especially if we banks tend to play a big role in those projects in the beginning. So how do you package them in such a way that much later on, institutional investors who've got the appetite for much more longer dated assets will be able to take those projects and finance them? So as banks, you have to price them in such a way that the other investors, institutional investors, will be able to see the return. Otherwise, it's not going to be so easy. And in the post-Basel world, we are normally not that good beyond, let's say, 7 years on average as banks. So how do you package them in such a way that later on institutional investors may have that appetite? And the other element is, do you have the institutional investors with the policy frameworks that allow them to invest in such assets? And I just wanted to end there for now, and then we'll pick it up during the questions. Thanks.
Thank you very much, Kwesi. I can certainly confirm that we've seen quite a bit of activity, early stage activity in the LNG space in Africa. And as you said, in Latin America, they've done a number of LNG projects, certainly in Asia as well. My own team at IFC Infra Ventures is engaged in a couple of LNG to power projects in Bangladesh. And this is definitely a segment of the market that we're going to see a bit more happening in Africa, particularly because the gas prices have come down substantially, and maybe there's opportunity to take advantage of this kind of gas to power solutions. Of course, you have to structure it in the way that the projects are bankable to be able to attract private investment. So let me move to Sylvester. Sylvester, you have a project, maybe many projects that you are developing. So maybe you can give us an update on the project, the LabSet project and others that you're developing, but particularly from the standpoint of how are you developing those projects to make sure that they are attractive to institutional investors? Please.
Thank you very much. First and foremost, I would like to let you know that last year when we came for the Cape Town conference, we were talking about beginning a number of activities. Today, I'm going to talk about progress made. When we talk about the LabSet Corridor project, some of the progress that have been made include the admission to the AU Infrastructure Project Championship under the Presidents. LabSet has also won an award in March in the US for being the global project in terms of opportunity creation. In as much as it is a young project, but globally it has the greatest opportunity that it is presenting to the global investment market. When we go to Lamu Port, because we did talk about 7 key infrastructure components, the Lamu Port, the railway, the road, the crude oil pipeline, product pipeline, refineries, resort cities, and international airports. Lamu Port construction works have begun in earnest, and as we speak, the contractor is already on board, and this is fully funded by the government of Kenya. The specific reason for which we are doing this is to de-risk private sector interests. When we first presented this project in a conference in London at the Lord Mayor's house, the private sector asked us how much they were going to recoup their investments, and considering that it was a greenfield, they expressed fears. And as a government, we therefore felt that there was a need to respond to that very quickly. So what we are doing for private sector is therefore to complete the first 3 months within 45 months. And the timetable is that within 24 months, the first bath will be ready. Within 36 months, the second bath will be ready. And within 45 months, the third bath will be completed. And we are therefore bringing private sector on board for operations of these baths. So we've already undertaken the process, one, to dredge the channel and to make it a deep sea port. Secondly, to construct the bath so that we present it as a business, as a going concern. What we are also doing is a construction of the roads to make sure that we have clear offtake. We are just completing 500 kilometers connection with Ethiopia. At the same time, the government of Ethiopia is also working together with the government of Kenya, and they are also constructing another 500 kilometers. So we have a clear offtake route to Ethiopia. One key uniqueness in this particular connection is that that road straight away links a 90 million plus population of Ethiopia plus a 45 million plus population of Kenya. That is about 135 million plus, straight away connected in business, transport, logistics, and trade. That was not there before. So for private sector, we've already created a level of integration that can allow private sector to pitch in Kenya and to trade between Kenya and Ethiopia. And with that offtake road, we are also undertaking the construction of the link between Kenya and South Sudan. The construction for this particular link will commence by August this year, as well as a construction of another 120 kilometer to link Lamu Port to an existing B8 road at Lamu Garsen. So the South Sudan link is about 338 kilometers, then you add to this other link. The rest of the link between Lokicha and Lamu, that is about 860 kilometers, that is currently under detailed engineering design with the support from the African Development Bank. And I also need to mention that the link with Ethiopia is being funded by the African Development Bank together with the European Investment Bank. And the design, detailed engineering design for the road is also being done with the support of the African Development Bank. So we have a lot of support from development partners. And concerning the crude oil pipeline, we are currently at the FEED study, that is the front-end engineering design. We just completed the pre-front-end engineering design at the end of last year. Last week, we did float a tender for design consultants for the FEED phase. And we expect to have an EPC contract upon the completion of the FEED study. There is also a new product that we see coming in. We previously had a product pipeline that was hinged or that was placed on the back of the refinery. But with the opening of the Ethiopian market, considering that Ethiopia still does not have a clear product pipeline that supplies that market, even though they have thought about one that is supposed to link them from the port of Djibouti. But you need to take note that the southern part of Ethiopia, which cares for slightly over half of the population, is mainly going to be served from the Kenyan side. So there's a new market, again, for a product pipeline, linking with the existing pipeline that is expected, therefore, to touch Ethiopia. So that's another new investment opportunity that has arisen out of the new linkages that we've just created. With regard to the railway, we've just completed the preliminary engineering as well as feasibility studies, and we are now going for detailed engineering design. And with regard to attracted and generated investments that I did talk about last year, we've already covered enough ground, and today we are having a 1,000 megawatts coal power plant that is already being prepared for construction. The tender has already been awarded, and we expect construction to commence soon. Currently, they are at a preparatory phase to progress to construction. We also have within the corridor the Turkana wind power plant, wind power project, which is about over 300 megawatts of power. And this is already being undertaken by a private sector investor, supported by, among others, the OPEC of US. We also have another private sector investor that is doing a desalination plant in Lamu for about 30 million gallons to start with. And this is meant to supply not just Lamu alone, but the entire regional enclave that requires this water. all that neighbors the Saline Sea. Together with this, we also have another component of this particular desalination plant that is going to produce about 2 to 3 million metric tons of minerals that are going to be extracted from the sea. So we have a lot of investment that are arising from this. And to support private sector initiatives and to make sure that we create the forward linkages as well as the integration that is needed for private sector to operate smoothly between Kenya and the rest of the countries. We already have existing bilateral frameworks. For example, we have an MOU with South Sudan. We have a road and transport agreement with South Sudan as well as Ethiopia. And we also have a bilateral agreement with Ethiopia on the development of the railway. As we speak, we are working on another instrument to bring us together under one of the regs so that we undertake the completion of the designs of the railway as a team. So we've already done all this to lay ground for private sector to find a more comfortable settling ground. Other things that we have done that do touch on what development partners or financiers usually require goes with the preparation for environmental issues as well as land acquisition issues. What we are currently doing is undertaking a strategic environmental assessment to make sure that any project-specific EIAs that will be done later will draw from the policy approval from the SEA so that projects do not delay. We are also currently undertaking a detailed survey and land acquisition for the corridor to make sure that when investors are coming on board, then they are not bogged down with the process of looking for land and negotiating with the local communities. So we've already learned from the projects that we've done before, and we don't want, again, to put the same hurdles that were in front of us when we were still learning on how to do mega infrastructure projects. So this is our pitch as we speak.
Okay, thank you very much. It was a very passionate speech. We can see that you have a number of important projects for Kenya, indeed for the region that you're pushing. And maybe during the Q&A, we could ask you a bit more specifically to pick maybe one or two of those and see which one where you believe the private sector could actually come in the near term, such as the Lake Turkana project, which is certainly a very good project that was developed and funded by the private sector. So let me move to John Oliphant. I'm going to skip Sandra for now. And John, you're the chairman of CRISA. Maybe you can first tell us about what you do a bit more at CRISA, but also tell us about some of the most effective and proven models and instruments in the market to really try to attract private institutional investors in regional projects and in infrastructure projects in Africa.
Okay. Thank you for the introduction. Morning, ladies and gentlemen. My task is very simple because it's mainly to say how do we match these opportunities that have been unpacked with capital that is looking for investment opportunities on the continent. Just to give you some stats, the total savings industry in South Africa, it's about 8 trillion. If you convert that to dollars, it gives you about $540 billion. And the actual pension industry in South Africa, it's about $250 billion. Okay? If you look at the rest of the continent, there is about a total of about $300 billion of African capital within the pension fund industry that can invest within the continent in terms of growth. And then if you ignore Africa and you look at the rest of the world, there is a study that is usually done by Towers Watson, where they look at what they call the P16, which are the 16 largest pension markets in the world. The total assets for the P16, it's about 36 trillion US dollars. Obviously, the US is a significant market. You know, it's got about $22 trillion in terms of the pension fund industry. So the challenge then that we have as Africans is how do we mobilize our own resources in the continent, you know, referring to the $300 billion to invest on Africa's growth story, in particular infrastructure. And then the second question is how do we mobilize external funding, which is the 36 trillion that is sitting with the P16 to be allocated for Africa investment opportunities. Now, the reason why there are certain challenges within the continent, it's mainly sometimes the contradictions that emerge within regulations. So what you would find is that if you look at, for example, within the South African context, you've got what we call a Regulation 28, which says, you can only allocate 5% of the portfolio to opportunities outside South Africa, but within the rest of the continent. Now, is 5% sufficient, and are many pension funds sitting on that 5%? And the answer is no, and the question is why, and that's what I've been asked to answer. But then externally, you've got a situation where you've got 36 trillion, and everyone agrees that Africa is the last frontier in terms of growth. So the question is, if Africa is only 2% of global GDP, and everyone expected to double and triple and so on, and there's no growth elsewhere in the world, why isn't a lot of capital flowing into the continent? My attempt to answering these questions, it's mainly around the perception of risk. So often people overprice risk, so we all perceive a risk in different ways, and we want to be rewarded for that risk. So in the context of an investor outside the continent, they don't want, and last night we had a dinner, and I called it a career risk, or what you classify as the CNN risk. Whereas, somebody, formulate their view of the continent based on what they see on CNN. If you see, for example, what happened in Marikana, you would have assumed that South Africa was up in smokes, the manner in which it was reported by CNN. Now, what you find is that if Africa contributes for 2% of global GDP, it means 98% of economic activity is happening outside Africa. So if you were to be the CIO of Calpas or Calstras, and you want to allocate capital towards the continent, if you were to allocate 2% of the portfolio, you would be sitting almost on a neutral weighting on a GDP basis. Now, surely as Africans would also want to give that person the comfort such that if they allocate 2% of the $36 trillion, which can make a huge difference, you want them to also be spending 2% of their time on that investment. Because what you don't want is to have an allocation of 2%, and then as a CIO, you're spending 60% of your time nursing this investment. So our responsibility is to come up with instruments that allows a person sitting in the US, which is the largest pension market, or somewhere in Europe, to make an investment and forget about it. They don't have to be spending or explaining to the investment committee if there's a bad story about Nigeria in the news, there's a special investment committee. We don't want those type of stories. So I think that's one of the challenges. What type of an instrument do we need to create that can give comfort to offshore investors? Within the African context, I think most of the bottlenecks are mainly around the regulation, and there must be a way to harmonize regulations across the continent to allow a cross-border investments, cross-border collaboration among the investors. So one of the ways in which you could address the issue of investment on the continent is to take advantage of the strengths that we have within the continent. And we know that the JSE, is the largest, stock exchange on the continent. It's highly liquid. So the question is whether can one come up with models that allow the full utilization of the listed markets. And I think in this example, I was proud to have been one of the founders of Gaia Infrastructure Capital, which is a listed special purpose company that is aimed at investing in infrastructure in South Africa and on the continent. The other issue that we need to be in a position to address is the issue of the skills gap that exists within the key decision makers within the pension fund environment. We'll all appreciate that being a pension fund trustee, for example, it's a part-time job. You only attend 4 board meetings, you look after the assets, it's not your everyday activity. And many pension funds, as a result, cannot afford to match having a board that meet 4 times a year with an in-sourced team, where you've got team that can look at these investment opportunities on a continuous basis and report back to the board on a quarterly basis. So, and what you find, the results for that is that outside Eskom Pension Fund or GEPF, a significant number of pension funds in South Africa have less than 10 billion rands assets under management. So it would not make sense for those pension funds to employ a team of experts internally to do investment analysis and do due diligence and so on, and make recommendations or to the board. And that's why in that regard, one feels that one of the instruments that are required is the one that will close that gap, allow smaller pension funds to participate in infrastructure opportunities in a more diversified manner, and in a manner that is safe for the trustees. And surely I think there is a space for a fund of fund in that regard. And again, I'm glad to have been involved in establishing the first infrastructure fund of fund in Africa. You will appreciate that, having moved from being a public servant to being an entrepreneur, when you are given an opportunities like this, you also have to reflect on some of the initiatives that you are involved with that allows private sector pension fund to participate in infrastructure opportunities. So I tried to give a broader perspective of the total amount of capital that is out there looking for a new home. And it's only up to us as Africans to find solutions that allow that fund, that capital to participate in opportunities, because there aren't any opportunities elsewhere in the world. Thank you.
Thank you very much, John. Certainly, the kind of numbers that you've put on the table are quite attractive. Even with 1% would be already extremely good. And of course, we will take 2% of that volume of funding for African infrastructure. But also, you propose a number of steps, including creating appropriate vehicles and instruments that could be useful for attracting private investors, private institutional money in the continent. But at the end of the day, we need to make sure that the project that we are offering for investors' participation provide an appropriate risk-return balance, and certainly that the risk is reduced or mitigated. So I will go to Alexander, and Alexander, I'd like you to share your views on some of the steps, some of the ideas that you have in terms of how to de-risk this infrastructure project, domestic or cross-border, so that those projects will become attractive to institutional investors. Because, at the end of the day, some of the risks are perceived, but other risks are actually actual risk, and they need to be mitigated or allocated to the best parties able to manage them. So what are some of your thoughts on this question, please?
Thank you very much, Alain. I want to really start on a very basic level, very simple level. I was part of a team yesterday, chairing a session at a table, and part of the reasons, part of the issues they raised was very, very basic, the legal environment. So you say, oh, what's wrong with the legal environment? And I think the legal environment is very important. We need to improve it, but it's not just improving it, it's how you improve it. And I want to start with the three regional or cross-border investments as an example to sort of ease me into the kind of changes we need. You all know about the Kenya-Uganda railway concession. This was a very big project for us. Kenya and Uganda were coming together, concessioning out a railway. We already saw that there were challenges when they were doing it. There was no single rail asset owning company. There was no single operating company. There was no single holding company to even hold the land. And during the procurement process, the first operator turned out to be, to say the least, basically a fraud. So that already can tell you that there were challenges in there. We now have one where you'll be involved in the next stage of your life at Africa 50, the SGR. This is a $10 billion within Kenya and another $4 billion to reach Kigali. Again, there's no single holding company, no single operating company, no structure that we can see. But if you're an investor, you can come in and participate. Lastly, I want to give one example of an oil pipeline. And my colleague here from LAPSET has already mentioned it. We have an oil pipeline plan from Lamu all the way to Southern Sudan and Uganda. We've been drumming up support for it, and the last 2 weeks or 2 months, basically that has fallen apart. Now Uganda's chosen a route via Tanzania, so you'll have a Tanga-Uganda oil pipeline. What was Kenya's response? We're also building our own, so you have regional cross-border pipelines competing with each other. And the head of state of Uganda gave a very good example, saying that if you have got 2 chicks that have hatched, you will not know which one will be a good runner. So you let the 2 chicks grow, you feed both of them. We now have 2 regional pipelines running from east to west in the same region. So that brings me to the kind of changes we need, the legal environment. We need more legal certainty. We need more policy certainty. And I would say we also need to enforce laws better. Enforce better laws between investors equally, fairly, and not cozy up, or you don't need to cozy up to the government to be seen as somebody who can basically invest in the region. And I believe this annual tinkering with our laws via the annual finance bill is something we need to stop. I believe one time Canada had a system where every 10 years they overhaul their laws completely. They don't tinker every year. Today the rate is 8%, tomorrow is 10, 20%, the next day is down to 15. Every finance bill, every year, brings in new laws. So if you can give investors policy certainty, legal certainty, the laws will not change at the whim of every finance minister coming in. So I think that is the first step. And I don't want to leave this point unsaid. Most of English-speaking Africa, our company laws were based on the UK 1948 Act, completely archaic, completely outdated. I think we have just now revised our law in Kenya, our Companies Act. I believe maybe Uganda is still far, Malawi, Zambia, they're probably still in the 48 Act. Because you now need new structures to be able to have a regional company. You can also cross-list across the board. You can have robust holding company structures. Most infrastructure that is cross-border might require holding company structures. The second change beyond the legal environment is basically increasing the supply of local finance to local partners. This was raised yesterday as well. The local partners cannot come to the table. A, they're too small, they don't have money, they don't have debt or equity capital. So if you increase the supply of finance to the locals, then they can also meaningfully step up to the plate. And I think in Kenya we're championing one policy innovation of consolidating our banks, probably following our Nigerian brothers. Our banks are too small. None of them can actually come up and give you $250 million and above. We also seek to ease, or we should ease, the listing requirements. Currently, our capital markets are listing anything, whether it's a commercial bond, whether it's an IPO, is like pulling teeth? It really is difficult. And I believe the NSF person from Uganda mentioned that they only have 8 listed companies. We only have 54 listed entities. And why is this important? We have seen you at ADB. ADB was one time proposing to raise a domestic bond in Kenya shillings on a domestic market to lend regionally. So that way ADB can actually finance the local currency part of regional infrastructure domestically. We have also seen Shelter Afrique raising money domestically for possibly regional infrastructure investments. So I believe those 2 areas increase the supply of local finance to local partners and modernize our laws. We cannot have this 1948 UK Acts. We now need very innovative structures. I believe the CEO of PTA Bank mentioned that they also go all the way down to financing SMEs as well. Now, SMEs in Kenya now can actually form a limited company with one director. You can meet virtually if you want, simplify reporting requirements, all of this to make sure local partners are strong. The legal environment is strong for investors. They can form creative or innovative company structures, and therefore they can actually come up and do regional infrastructure. I believe those 2 areas is one I would like to share with you.
Thank you very much, Alexander. I think I particularly like your views on improving the the legal and regulatory framework. Certainly, it's very important. But I'd like to highlight, and actually agree wholeheartedly on the need to have a more local participation in our infrastructure project in Africa. I think it's not discussed enough, but for me, it's a huge manner in which political risk can be mitigated by having strong local participation, ownership on the project. Now, because those projects are capital intensive and there's not necessarily enough capital in the local and regional market, we really need to figure out ways in which we can bring more participation of local investors and local sponsors in those projects, I think. Now, let me go to Sandra. You are with Standard & Poor's. And I wanted to finish with you, at least for this first round of questions, because if we're talking about institutional investors, bringing them to participate in the infrastructure project in Africa, many of them would want to hear the views of global rating agencies such as Standard & Poor's. So I'd like you to share your views as to, what it will take. What are some of the steps that will need to be taken to try to attract institutional investors into infrastructure project in Africa, please?
Thank you. Good morning, everybody. My job at Standard & Poor's is on the commercial side, and I relationship manage the Canadian pension funds, a couple of Middle Eastern sovereign wealth funds, and a few of the Far Eastern sovereign wealth funds. I also look after business development for project finance, which means that I work very closely with developers and sponsors. As you appreciate, the infrastructure world is quite small, so you find the same sponsors working in Africa as they're working in Latin America and in Asia. And then very quick health warning that I'm obliged to give as a regulated body is that as a rating agency, we do not provide advice, we provide independent opinions. So, to the question from the chair, I think with infrastructure, whether you're looking at a project or you're looking at a corporate, even if it is an airport, and you're looking for investors, be they domestic or international, first thing, think about who it is you want to attract. The pension funds and the insurance companies are looking for long-term, and by long-term, I'm saying 7 years plus investments. The infrastructure funds, they're in the game for 3 to 5 years. They will flip their investment in you, and this is predominantly the debt investment. The other thing that I've heard regularly, and it goes hand in hand with infrastructure, are regulators. Not so much in project finance, but in the corporate space, where you have electricity companies, water companies, airports. I haven't seen it so much in ports. What the investors are looking for are they're not only looking for a regulator. Most countries have regulators. What they're looking for are for regulators who actually work and, to use it very plainly, have teeth and will use their teeth. So that means they have a utility company or water company, tariff is set, or it does not even work hard at putting in the capex that is required, the minimum capex that's required by regulation. These are where some of the investors will stop at certain areas, even in Western Europe. They will not go into some areas in Europe where they are long-standing regulators. The regulators have not been able to show a history of actually exercising their power and making sure that these utilities or these transport companies meet whatever objectives that were set. What do we bring to the table? We bring to the table an independent opinion. We've been rating projects especially since 1992. So we followed the transition of these ratings. They go up, they go down. And that we show that we've got enough knowledge within our organization as to how a mining project in Australia operates in comparison to a mining project in Brazil. And that rating level should stand the test of whatever its default probability is whether it is operating in Canada or in Brazil or in Australia. That's what an investor is relying on. The other piece that we try to do very much is to keep our ratings as stable as possible. And yes, we are rating projects that are 25 and 30 years, and we're the first to admit that our crystal ball is not always very clear. But what we're trying to do is make sure that we look at a project during the construction phase and during the operation phase and try to see what is put into the project, not by us, by the advisors or the developers or the governments, to mitigate any risk. And ultimately, what our rating is speaking to is probability of default. In basic terms, it means that you have a coupon due or you are due to repay. Are you, the project, able to repay what payment on the day that it is due? If you're not, what mechanism have you put into the structure to either have a pocket of cash that can be drawn to make that payment, or whose door can your investor go to knock on the door and say, my payment is due today, please can you give me the payment? This is where guarantees come into place. This is where enhancements take place, either coming from multilaterals, coming from insurance companies, but that's what our project rating is speaking to. And I think what I'd like to say to a lot of you sitting here looking at Africa is the questions that you face and some of the challenges you face attracting investors are no different to what projects in Central East Europe and even projects in the UK have to deal with. At the end of the day, it's what you're structuring and ultimately what the project company, whether it's the developers or the regional government or the central government, is committed to. In terms of political risk, governments will change, the life of a project carries on. How strong has that project been structured to withstand this? And what international investors face in Africa is that most of the projects are domestic. So they're earning their currency they're earning their money in a local currency. So the hurdle is the currency risk. It's not always about the sovereign risk. It is the currency risk that is the hurdle. And then it's been said, and I'll say it again, is the commitment. What is the pipeline? And how much do governments actually stand by the plans that they do say they want to commit? Infrastructure is important to every one of us and to all our fellow countrymen, but it is about government or local government's commitment to follow through and make sure those things happen. And more importantly is to actually prioritize. We've seen this a lot in the Middle East, where you had a lot of infrastructure plans, a fair amount of the developers were government-related entities, and in some countries you had about 15 government-related entities all dealing in infrastructure, all saying they want to go to the capital markets. There has to be an orderly process. And whether you're a lending banker or you are a bond investor, you're going to work out, sometimes with the help of our rating, as to how important is that project to that country and how many people, how many companies in that country are going to come to the markets. Which one is the most important and which one could run that risk of the government saying, I've supported the first 10, I really don't have enough money in my pockets now. And so what are you going to do? And this all comes down to the structuring. And I think I'll stop there.
Okay. Fantastic. Thank you, Sandra. Very informative remarks. I think one of the things that you said many things, but this issue of currency risk in infrastructure project is even more acute these days in the context of Africa because of the macroeconomic challenges, the headwinds that the continent is facing due to the sharp decrease in commodity prices. Certainly, a currency risk is in most infrastructure projects is an issue because in most infrastructure deals have local currency revenues. But I see more concern today in the context of Africa because of the macroeconomic issues. So thank you. I'd like to go to the audience if there are questions. I know John has to leave at 12:30. Maybe I will pose a follow-up question to John while I'm soliciting questions from the audience. John, what I wanted to ask you, if you may, maybe talk about some success stories that you may have seen in terms of seeing projects that have managed to attract institutional investors' money, so that you can actually give to Alexander and also Sylvester a sense of what kind of project that institutional investors have actually financed before. I suppose, I don't know if you have of your mind a couple of examples that you can share with us.
One of my panelist members here said one of the things that we need to get right is legal certainty as well as policy certainty. Now, if you pick that example and you look at the success of the South African Renewable Energy Program, where the South African government was in a position to define the rules of how the private sector can participate in investing in the renewable energy program, and now it's almost in round 4 of such a program, is that they have managed to attract 120 billion of private sector capital to invest in the renewable energy program in South Africa. And that's mainly because the rules of the game are much clearer and the investors are prepared to participate in the program. What we've also seen is that the de-risking of the project, where the government, at the back of it, provide a guarantee. What we find is that most investors are saying, well, if I invest in a renewable energy program in South Africa, for example, what type of risk am I really taking? Yes, you've got a middleman in between, which is Eskom, that the single buyer office, but in reality, you're taking technology risk as well as sovereign risk in those projects. And what we've seen is that the market has started to price it quite well going forward. And then, yes, obviously, it's, the world of infrastructure is not always perfect. You make certain assumptions when you make an investment. And in my previous role, I've had an opportunity to participate in a Pan-African fund that invested in an airport in Tunisia. So even there, one had an example of where you get a report from your advisors that says this is political risk, this is that, and then the actual assumptions, as the lady has said on my right, they don't play out the way you had assumed. And I always say to people that you need to accept that there's risk everywhere. I mean, if you look at Europe, for example, you had government defaulting on their increase and so on. So why are they being treated differently when it compared to African investment opportunities? So there are good stories mostly, and there are examples where you could get things wrong, but you need to learn from those mistakes.
Okay, thank you, John. I thought there was a question Barbara has a question. There was also a question on that side of the room, but I don't. Okay, sir, I can see you over there. Please.
Sure. I'm Matthew McDevitt. I'm from Dalberg Global Development Advisors. We're a strategy consulting firm that works in emerging markets. John, I know you have to go in 5 minutes, so this is largely directed at you, but I'll make it quick. Along the same sorts of themes surrounding kind of the success factors of these sorts of projects, when we're looking at pension funds in South Africa, you mentioned that not many of them have actually managed to invest that 5% kind of limit that they're allowed to. But which examples have we seen of those that have? And where they have been able to invest 5% or close to, what do you think is driving that? What are the success factors really, either internally or kind of just surrounding their particular decisions?
Okay, I'm going to take Barbara's question as well, so we can take all questions together because we really have to wrap up also.
Okay, my question is for Sandra. Okay, I used to work for Moody's, so I've been inside the belly of the beast. Okay, You brought up a really critical issue, currency risk. And, you know, here we have this enormous challenge of building the physical background, the backbone of Africa. So if we're going to search the history of how deals have been, cross-border deals have successfully mitigated currency risk. And, you know, for example, rating agencies have provided, through the monolines, offshore receivables that have been successfully rated AAA, taking 100% RAP, okay, because you've had offshore lockboxes. So you could have, that's easy comparatively, right? So you could have contracts, offtake agreements with corporate clients using the railroad that are going to export them and have a match. What I'm having a hard time wrapping my brain around is the local currency, foreign currency mismatch, of course. There's only, to my knowledge, there's only been one instrument that has pierced the sovereign rating, and that was in 2001, the foreign exchange liquidity facility that OPIC put forward for an AES Tietes transaction. It has never been replicated, and we're exploring how to bring that to bear here. But do you have any solutions for us on this or ideas of where we turn? Thank you.
Yeah,
on the currency risk.
That's
Yeah.
quite technical question, but I mean, I like the question. Actually, I'd like to engage you on that as well. What I'm going to suggest is that John and Sandra, you answer the questions, but let's give some time also to all the other panelists to wrap up and you know, and share a few comments in wrapping up the session.
Yeah.
John, you start, please.
Okay, no, thank you. The question has been to say that, you know, funds that have invested the full 5%, what was the driving force? What I could say is that it's mainly driven by progressive boards. So you find that most pension funds that have, trustees that are curious, attend conferences like this, they often question their own investment consultants to say, you know, you've been coming to present to us investment opportunities, but you haven't told us enough about the continent, and everyone is talking about the continent. So, often I've seen that being driven from the top. I must be honest, you know, if you look at the asset consultants who are often classified as gatekeepers, I don't think some have been as strong as they ought to have been in doing more research on the continent. And I think this example came yesterday. The Africa Investor hosted a dinner yesterday with the Eskom Pension Fund, and the CEO of Eskom Pension Fund gave his own story of how they've started to invest on the continent, and he said that they decided to go elsewhere to get advice on how to approach the continent, and he deployed his own team into the continent to do more research for him, to advise the board on the Africa strategy for the fund. So that the challenge then that stands is that not many pension funds have the capacity to push ideas down to their own advisors and ask their advisors to investigate further. And the question is then, are those funds continuously going to miss out on these opportunities? The other challenge that we face, which I didn't mention in my remarks, is the actual structure of pension funds. It's predominantly a defined contribution structure. Of course, you've got a few funds that are defined benefit, and obviously that presents a challenge, because in a defined contribution structure and in a slowing economy where you've got members being retrenched and leaving the fund, you need to be in a position to liquidate the investment and give them the money back. Because often people don't preserve their retirement savings, they take them as cash because they're trying to survive in between jobs. So that's one of the major challenges, especially in the context of South Africa, where a pension fund of 10 billion rands is saying, well, if I want to put 5% of the fund to these long-term projects, what happens if I need to redeem the market? And I think that's where one of the opportunities could be to create a secondaries market where people can sell their sell their commitments in a secondary market, so that you deal with that liquidity issue.
Okay.
Yeah.
Thank you very much, Sandra. You want to?
My analytical colleagues would be better placed to answer your question precisely, but I'll give you the benefit of what we have seen. Utilities and transport companies, as I said before, are earning money domestically, and there have been mechanisms put into those transactions. But like all things that are helping to either remove risk or to enhance a project, or that means to get the rating up, comes at a cost to the project. And whether ultimately either the developers or the local government, if it's involved, or the central government is willing to give up that cost, there can be that kind of mechanism. We've also seen deals, though they haven't completed, where banks have tried to put in some sort of facility, whether it's a domestic bank, in some cases been an international bank, where they've tried to route the cash flow through a special fund that they have. How much they're actually charging to the project, I wouldn't be best placed to answer, but we've seen that kind of situation. I mean, by and large, all projects generally will not break sovereign ceilings, especially the domestic projects. It's in the commodities that you see projects actually breaking sovereign ceilings. Sometimes that can be from the PPA that they have, the length of the PPA. We've seen in the oil and gas sector, and Egypt was a perfect example, where they kept the cash flow from the from the gas, beg your pardon. They kept it offshore for 3 years before they brought it back into the country, and that's how they got their projects done, almost like a future flow transaction. There aren't very many mechanisms, but they come at a cost to the project.
Okay, thank you very much. I could add, actually, at IFC, we've done a couple of transactions. I don't remember the name, Barbara, I could come back to you, in Latin America, where through the B-loan umbrella, we've been able to pierce the sovereign ceilings, because essentially B-loan will give you preferential access to foreign exchange, and it's rare, but it has been done before, and it comes at a cost. But most of the transactions that have pierced the sovereign ceiling are future revenues. When you have export revenues, of course, that's a bit easier to do. But even with domestic revenues, if you have a local currency on a national scale, which is high enough, and then you put the bill on umbrella over it, sometimes you're able to pierce the sovereign ceiling. So now let me get the wrap up, actually, starting with you. Please
Just quickly on a theme that came up briefly on this, on the point John made about scale in the institutions. I'm going to use a South African example. We recently did a transaction where we were syndicating part of a loan we had done to potential institutions. And I remember in that case what they did, actually, they called us and they said, no, we don't want to use you as advisors, but you're going to come and tell us, because we're going to ask them the same questions that your credit process asked. And we want to test as to how you came to the answer you came to in financing those projects. And effectively what they were doing was they were insourcing our knowledge and skill on that sector, which they didn't have internally, and using our own metrics to try and close a gap that they have on their side. Obviously, they would use one or two other advisors, but effectively, they effectively insourced us in the process. In fact, one of them was so comfortable, they took a bigger number than they thought in the beginning. And secondly, paradoxically in South Africa, you find the same people are actually invested in utilities listed assets, let's say this National Roads Agency Limited. And maybe because of the work that maybe Sandra and them do, they find it easier to deal with the institution than to deal with a specific project. And probably the big effort in South Africa is to get those institutions to be more capable at dealing with a project in the same way that the banks are able to do. And my last point around the currency one, but it's going to be focusing more on the issue of the gas to power one, maybe not on the revenue-related side when you've got an oil and gas project, is that if you look at South Africa, and this question is arising a lot in the South African context, is that if you think about it now, the consumer actually pays for a dollar-denominated asset, but they never pay in dollars, they pay in rands. Every time they go to a fuel station, there's a mechanism and a formula that deals with that. Now, the big one around the energy and electricity side is that, okay, you can't, in South Africa, the South African energy market, you can't change your prices of electricity every day. There's probably an annual determination or a medium-term determination. It's more about how you structure a transaction in such a way that the investor is comfortable that the gas price that comes in, even though there's a currency mismatch, the consumer at the end of the day will pay for that, and how the sovereign allows a mechanism that allows for that translation with a regular review by a regulator, so to speak. And that's the generic approach that's likely to be used to deal with that currency mismatch from the gas to power side.
Thank you very much, Kwesi. Let me move to Alexander. Sylvester, Alexander over there. Sylvester, please, why don't you give us your closing remarks, please?
Thank you very much. And just to give a quick closing remarks, as we are all aware, the LAPSSET Corridor project is aimed at creating a land bridge across the African continent. One of the key features of the African continent is the lack of accessibility, particularly in the central parts of the continent. And by creating this accessibility, we are therefore increasing the market size. And just to look at what the LAPSSET Corridor project is doing, even just within Kenya alone, it is opening up about 200% more investment space, considering that the existing corridor basically opened up just about 30% of the country's land space. So we are actually unveiling more than double just within the country alone. And then now you look at within the region, linking with Ethiopia, South Sudan, and the rest of the region, we are actually integrating a population land space of about 300 million plus. And if you are to measure this in the world that perhaps most of you have known best, the US, the EU, among others, then you are actually looking at a bigger opportunity in Africa, just around the LAPSSET corridor. Therefore, to look specifically, we are unveiling with the infrastructure that I did explain about. We have about 30,000 hectares of land in Lamu for a special economic zone, for which the infrastructure that we are building will therefore allow manufacturers, among many other investors from different parts of the globe, to take advantage of this infrastructure. The Lamu port is therefore also unveiled for private sector, for operations. The oil terminal, the coal terminal, also for private sector. Crude oil pipeline. The wind power projects that have a lot of opportunities for private sector to invest, particularly in Marsabit, Lamu, and Turkana areas. We also have power transmission that you do know quite well, and we are also looking forward to having private sector to participate in power transmission now that we have a lot of power generation projects. We also have logistical terminals or logistical hubs within the corridor from Lamu, Garissa, Isiolo, Moyale. And when I talk about Moyale and Nakodok or Nadapal, I'm talking about the border with Ethiopia and the border with South Sudan. We are talking about a product pipeline that has therefore come to be of great interest now that we have opened up the link with Ethiopia. We have the agricultural value chain, about 10 value chains being unveiled through a detailed study that has shown us what is possible within the entire corridor. We have tourism potentials, and with over 10 national parks and national reserves with very unique flora and fauna. All this, together with Mount Kenya within the vicinity and Lake Turkana, among many other areas. We also have quite a robust catalog of service sector that can actually be invested into by private sector. So what we've done is that by opening up this new 200% more space, we are actually recreating, re-energizing, and reinventing the investment space in Kenya, in East Africa, and in Africa. Thank you.
Oh, thank you very much, Sylvester. Again, very passionate. Look, I think what you're doing really is a huge infrastructure development program, which is quite impressive. And I think we have to acknowledge that the private sector is not going to be financing all these projects. There is a role for the public sector to finance some of the projects which are actually creating the enabling environment for the private sector to come in and do the project that the private sector does best. So in all the projects that you've listed, some of projects will be more suited for private sector participation than others, but all of those projects are very necessary to create that market. And so I
spend 1 minute just to explain that point.
Please.
Yes, we've also taken a strategic approach as a country so that we create the platform for private sector. We've created 3 different streams. One, the stream in which the government is taking the lead to clear areas which might not make a lot of sense to private sector with regard to returns. But they are quite critical in facilitating private sector investment. For example, at Lamu Port, we wouldn't ask a private sector to go and dredge the channel and to make the port a deep sea port by creating that channel. But we have sunk money as a government so that any other private sector investors that want to invest now in the port berths that we are going to make available, therefore would find enough reason and enough facilitation.
Fantastic. Thank you
Secondly,
very much. Okay,
Chair,
please.
we have also made sure that we have done the basic project preparation frameworks so that private sector does not have to come and start from the scratch, but you already find data among many other facilitative mechanisms, even cross-border mechanisms. Thank you. I'll stop there.
Fantastic. I'm sure you can speak for a lot more time because you're so passionate about this, which is fine. So, Alexander, why don't you, you have only 30 seconds really to finish, if you may, give us closing remarks.
Yeah, I'll try. I think
Sandra, okay. Sandra, you can have 30 seconds. The organizer will kill me, but Sandra, please go ahead, and then Alexander will finish. Sandra? Yeah, please.
Apologies. Where do I get interest from institutional investors and from banks who are advising in Africa? It is about solar. We do a lot of renewables work from the Spanish developers, and a lot of the Spanish developers are also refinancing their renewable projects in Iberia. Some of them are also providers of turbines to renewable programs. The South African renewable program, I've been talking to some of the bankers now for about 4 years. And again, some of the people from the first round are wanting to look at having their projects rated to see whether they could change the structures on their bids on future rounds. Refinancing of oil and gas pipelines in Central Africa. We did some indication work in West Africa. In fact, we privately rated a couple of mines in West Africa, but they were owned by private equity, hence they were kept confidential. In East Africa, there have been interest regarding the rail, but nothing really committed to a indication rating is where we do a lot of our work. So it's really renewables, which is where people will progress further to full ratings in Africa.
Thank you. Fantastic, Sandra. Alexander, please.
Thank you very much, Alain. I really want to just close with one comment on the legal and policy certainty, and also look forward towards your new work at Africa 50 by giving that example of the pipeline. I think to an investor, both domestic and international, you cannot have a situation where we have two competing east-west pipelines in Kenya. We also have now, he's developing a port in Lamu, and Tanzania in Bagamoyo has an $11 billion port being done by the Chinese. So they're competing, two competing ports. How can you allow that? And if, say, I invest in the Lamu port, and I know Bagamoyo is another $11 billion port, that policy uncertainty is not good. You must really just have the regional governments agreeing, we will share infrastructure, we will compete on services among ourselves, but we'll share infrastructure. The other thing that really alarmed me was this thing of Dakar that USAID presented earlier, where you're almost reaching the finishing line to financial close, then the central government says, sorry, you cannot raise debt as a city of Dakar. We also have the same uncertainty where our 47 counties want to raise debt, want to issue all these nice instruments to finance very localized infrastructure. And central government is saying you need my approval, maybe you don't. It's very uncertain. Yeah. So you really must nail down the legal environment and get it to be certain, and governments do not compete.
All right.
Is that what called co-opetition? Cooperating and competing at the same time. Yeah. They should really work together. Thanks.
Thank you, Alexander. Thank you, but I think we need to wrap up. Sorry, because the organizers are looking at me with stern eyes and saying, so thank you very much. Let's give a round of applause to the panel because they did a very good job.
Doing business in Africa, you can't afford to be without Africa Investor.